All right, welcome to the Explainer. Today, we are cracking one of the most important codes for your accounting journey, and of course, your success in the LECPA, Philippine Accounting Standard 32. We're going to get right into what really separates debt from ownership. Okay, so let's dive in. At its heart, PAS 32 is all about one big question. Is this instrument debt or is it ownership? And believe me, this single decision can completely flip the script on a company's financial story. So why is getting this right such a massive deal for you as a future CPA? Because the stakes are incredibly high. If you get this wrong, you could be misleading everyone, investors, banks, you name it. It can make a company look way less risky than it actually is. Nailing this classification isn't just a nice-to-have skill, it's absolutely core to what we do as accountants in the Philippines. So, to make sure this all sticks, here's our game plan. First, we'll cover the one rule that rules them all. Then, we'll see it in action with a preference share showdown. After that, we'll decode some really complex contracts. And finally, we'll wrap it all up with your very own LECPA cheat sheet. Okay, let's kick things off with Section 1. We're starting with the single most important principle in PAS 32. Seriously, if you get this one thing, you're already halfway there. This right here is the golden rule. It's called substance over form. What that means is we totally ignore the name of the instrument. I don't care if it's called a super-duper awesome share. We look at the contract's economic reality. What is the company actually on the hook for? Now, check out this definition. The key phrase you need to tattoo on your brain is contractual obligation. A financial liability exists because there's a promise the company absolutely cannot escape. It's a duty to pay up. Equity, on the other hand, is the complete opposite. It's what's left over for the owners after all the bills are paid. You know, assets minus liabilities equals equity. Well, that's it. It's the residual claim. There's no predefined promise to pay the owners anything specific. So let's boil it all down. Here's the ultimate litmus test. You just have to ask one question. Is there a contractual obligation to deliver cash that the company cannot avoid? If the answer is yes, bam, it's a liability. If the company has the choice, the discretion, to pay or not, then it's equity. Simple as that. All right, theory's cool and all, but let's see this in action. We're moving on to a classic you are 100% going to see in your exams, preference shares. This is where the rubber meets the road. And this just perfectly illustrates our one big rule. With redeemable shares, the person holding the share can knock on the company's door and say, "Give me my money." That creates a mandatory obligation for the company, so it's a liability. But with callable shares, the company, the issuer, holds all the cards. They can choose to redeem, but they don't have to. And that choice, that discretion, makes it an equity instrument. See? It all comes down to who has the power and the obligation. All right, you're crushing it. Time to level up. Let's get into the really tricky stuff. The edge cases that separate the pros from the rookies. If you can master these, you'll have a serious advantage. Okay, so check this out. A puttable instrument. It gives the holder the right to demand cash. Right away, your brain should be screaming, obligation, which means financial liability, right? I mean, it seems super obvious. Well, not always. PAS 32 has this very, very rare exception to the rule. For a puttable instrument to be classified as equity, it has to meet all three of these strict conditions. It has to get a proportional slice of the pie if the company closes, it has to be the absolute last in line to get paid, and it can't have any other liability-like features. If it checks all those boxes, it's acting so much like a regular share that we can call it equity. This brings us to another huge area you've got to know inside and out. What happens when a company says, "Hey, we'll pay you, but not with cash. We'll pay you with our own shares"? Does that automatically make it an equity instrument? Not so fast. There's a really strict rule here, and it's called the fixed for fixed test. It's powerful because it's so simple. The only way a contract settled in a company's own shares can be equity is if a fixed number of shares are exchanged for a fixed amount of cash. If anything is variable, either the number of shares or the amount of cash, it fails the test. And here it is, your study hack for this section. I want you to remember this forever. Just repeat this to yourself. If it's not fixed for fixed, it is not equity. Period. If either side of the deal is variable, it's a financial liability. That's it. Don't overthink it. Okay, we've covered a ton of ground.
Now let's lock all this knowledge in so it stays with you for the long haul. Get ready to screenshot the next slide. This is your high-impact summary for your LECPA review.
This is it. These 5 points are the absolute foundation of PAS 32. If you master these, you can tackle almost any instrument they throw at you on the exam. It's all about substance, obligation, who has the choice, and that super strict fixed for fixed test.
So, what's the big takeaway from all this? It's that you now have the framework, the tools to look past the labels on a financial statement and see the true substance of these instruments. And trust me, this isn't just about passing an exam. This is about developing the critical thinking skills of a real CPA. So go on, pick a company listed on the PSE, pull up their financial statements, and see if you can spot these things in the wild.